From the morning reading, the SPY double bottom breakout multi-week target of 207.07. All 9 sectors moved higher on Thursday. XLF, XLI, XLB were the strongest sectors, while XLE was the weakest sector. Oil futures rose. Breadth strengthened as advancers led decliners 2.83 to 1 on the New York Stock Exchange and weakened slightly on the NASDAQ, where advancers led 1.48 to 1. The SPY breaks out a double bottom resistance at 194.58 on February 1st, but closes at 195.54. The SPY has a 6-week target of 208.07. All 9 sectors rose, TLT bonds rose, and TNX interest rates fell. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:18 a.m. Central Time, and I am recording this in preparation for the market day of February the 26th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report, and indeed our overnight was pretty active. We have a situation where this breakout is in a continuation pattern in the overnight. So leading into today, the S&P futures at the time of this cut were up about 12 points, or up nearly 2/3%. Russell futures are up about 0.8%. NASDAQ futures are up also about 0.75%. Dow futures are up over 0.5%. Crude oil up sharply about 1.3%. Euro down about 0.25%. Bonds down about 0.5%. They're in rollover and should have the majority of the volume on the new contract sometime today. Gold's down about 0.33%. China is also up nicely. In fact, all the overseas markets we follow are up. China up about 1%. Hong Kong up sharply about 2.5%. Japan down, up about 0.33%. Germany up sharply about 2%. And the United Kingdom up about 1.25%. In terms of macroeconomic reports for today in the United States, you have preliminary GDP. So that'll be the big one. That'll be before the market opens, and it'll be accompanied by the core price index, good trades balance, personal spending. After the market open, you do have the University of Michigan consumer sentiment, so be aware of that. In terms of current volatility conditions, we have very low short-term VIX. First time we've seen below an 18 in quite some time. Skews also quite benign. IV percentile across all 4 of the S&P and other indices is very low. In the bottom third of the percentiles, S&P at a 29, Russell at a 34, NASDAQ 32, Dow at a 27. We did have standard deviation moves put in on 2 of the indexes yesterday, the S&P and the Dow. They are the most conservative, so it's of note that this breakout has been largely driven, and we'll see more evidence of this, but it's been largely driven by a rotation towards the more conservative holdings and dividend-paying stocks. So we'll have to see if we get widening breadth as we go along. Also note that out of the last 10 trading days, we've had 6 with standard deviation moves in the S&P. So while there's very little fear going on right now, as evidenced by this falling VIX and the the fear premium, as it were, certainly not pricing in a lot of volatility. We've actually had pretty significant amount of price volatility, but this price volatility has been done without accompanying fear. So make a distinction there. We do not have calm, quiet markets and lack of volatility. We have plenty of volatility. We don't have the kind of volatility that creates fear conditions. So there is a difference. In terms of the charts, we go to the SPX, and you notice here we've been talking that we need a confirmed close above these triple tops. Well, we got that with yesterday's action. It came right in at the close of the day, and it closed right at the highs of the day. So very strong bullish candle coming through the resistance and closing above that zone. So at this point, we have a confirmed breakout of the range that we've been in since early January. And it was a pretty significant range of about 100 and something points, about 140 points. And at the same time, we had, a triple top during that time. We had a double bottom at that time. And as one of the authors in the morning reading mentioned, now that we've had a breakout of this pattern with the double bottom, we now have a measured move target. And we're likely going to be looking for a measured move target up in this area about where you see these swing tops. So don't get too complacent with this. If you are still short, you're going to probably find that you're going to see some significant heat coming along, unless we have an immediate reversal. And we saw that with the Dow. In fact, we can go ahead and look at the Dow chart. We had this confirmed breakout, which immediately reversed, but that then just set up into a new bull flag pattern and powered through that former high even yesterday. So this is actually quite bullish. And if you look at and focus on the most recent pattern, once you had the reversal candle, it confirmed 3 white soldiers, bull flag, up through resistance, confirmed breakout. Looked like we had invalidated the breakout, but that then settled into a new bull flag, and then that confirmed a breakout yesterday. So we've had a lot of very short-term bullishness with confirmed re-entries now in 2 different places following the 3 white soldiers. So this pattern here was very unusual, and not just at 3 white soldiers, but also the size of these candles coming off of a 52-week low in many of these patterns. And at the same time, that did follow through. It did run up against resistance, pulled back, but then powered through and then back again. So this is very, very bullish. You got to accept that a lot of the technical damage that had been done back in early January has been healed. Now, we still have a lot of room to make to get back to where we were come December 31st, but an awful lot of that near-term resistance has been taken out by the bulls. And by that, I mean the institutions. This would not have gotten this far without institutional participation. Also, with the Russell, now this one, of course, has been in a much weaker pattern. We had a lower low and a lower high. It still has not broken through this primary resistance area here. So it's still playing catch up, but still the short-term pattern, 3 white soldiers, bull flag, a bit of a consolidation, call it a high breakout right now off of this short-term pattern, and now coming into the resistance zone. So it's about to find itself in a significant test, but much easier for it to come through that resistance when it is being led by the S&P and the Dow than it is for it to go through by itself. So it's trailing, but it's trailing behind strength of the other indices. And the NASDAQ, you also have a very similar situation to the Russell with the lower lows, the lower highs, but then, bull flag pattern once again. Again, very much the same kind of pattern we had in the others. Bull flag, you're making higher highs in the short-term pattern. We had a higher high here, a higher high, now a higher high. So we continue to make higher highs, but coming up against resistance. But again, much like the Russell, following into that resistance with the backing and the wind at the back of this index, that you have the S&P and the Dow already moving through their resistance areas and moving up into more clear area. And you see on the NASDAQ, if you actually get up above this area here, it's not a lot of resistance in here. We could very quickly swoop up through back towards these areas here and back towards near the prior highs before you run into an awful lot of significant resistance. So these near-term resistance zones that we've been watching in the various indices are very important, and once broken, they really do open up a significant zone of additional bullish potential. Doesn't mean it's going to happen, but certainly we've set up in a very strong pattern for that to happen. And you see here with the VIX, and of course this is a future, so this includes today, and you see today gapping down. We've had, in this case, now on the futures, we're still not below an 18. We did show the short-term futures as below an 18, but even on the big picture, the regular VIX futures contract, we're still getting relatively low and much lower than we've been in quite a number of weeks. You got to go back to the year end before you find lower levels. Now, we're still elevated. We're still not in that 12 to 18 area that we like to call as the range of the bulls, the healthy bulls. And indeed, I would not yet call this market a healthy bull market, but I would call it one where the short term and now the intermediate term have shown significant improvement, and certainly the bias is heading that way. In terms of bonds, and the bonds are a bit of a mess. We've had a lot of auctions this week, and we've had rollover coming into today, but still price is price, and this pattern is a bit of a consolidation. Notice that it is not totally broken down, so we continue to see an awful lot of defensiveness, and we'll see this when we look into the sector specific information, but the money's still holding on in many ways to these more defensive areas. If we look at gold, look at gold. I mean, gold has actually, formed a bull flag, or perhaps a complex bull flag. At the very least, you had a pennant, and then that has broken out, and it's, looks to be headed back towards its all-time high. So gold and a bullish pattern, bonds and a bullish pattern, and then other defensive sectors such as XLU. Look at this, all-time breakout here in utilities yesterday. At the same time, you had the S&P and the Dow breaking out above resistance. So very, very defensive orientation here. Let's go to the regular daily report. We continue to see healing here, though not in all clear in all areas. Intermediate term phase opinion is now at phase 4. Price patterns near horizontal resistance, and indeed we just broke through that horizontal resistance yesterday, and would be looking to now come into other horizontal resistance areas. This pattern could last for several weeks, and that would be perfectly normal. So this is certainly a bullish market trend phase. In terms of the market posture on the intermediate trend, we have from IBD a confirmed uptrend, though the accumulation distribution score for the S&P still remains a pretty woeful D- in the NASDAQ and E. These have not improved even with many of these other short-term signals improving. GMI index is still a 3 out of 6. That author has started to take some positions, starting to look for leadership and to expose some cash. So this is starting to be a sign of some transition here as well. And decision points, we of course have had the stack in a mixed fashion, with short-term signals all now universally up, but intermediate term showing at best neutral and not yet showing those signals of turning up. I expect that this will start to show up here in the near future. It's going to take a while for long-term to turn. And until we get all these in agreement, we're in something of a transition market. And remember, now that we've broken through the lower range, we've just entered it into the former range, and we're still playing between the less than the all-time highs. So this is a market that is, with a certain bias, certainly improvingly to the bullish side, and yet has some technical damage that is not yet overcome. And in the intermediate and long term, we still have some signals that are rather weak. In terms of position sizing opinion, you do have the 100% on the one system and the 75% on the other system. So those certainly have come up from where they were. Intermediate term market posture, very strongly bullish with a weak bullish sentiment line. So you'd like for this sentiment line to improve. That will have to happen with time. This bullish trend will need to sustain itself to be able to get this up and stronger. But certainly in terms of the posture itself, I mean, we're about to go into the very, very highest areas. So a lot of improvement. You see Russell even now up over 50 in a pretty strong order. In terms of the hedge risk level, we've gone to level 1. As we said, we would drop to a level 1 if we got a confirmed breakout of that former resistance area, and that happened with yesterday. So we continue to drop, and to go into level 0 plus, we would need to drop probably, we probably would need to see some continuation, ideally another bull flag and continuation up into this new area, be able to see that things are actually going to follow through and not just do like they did with the Dow the first time it went through resistance and just whiplash right back into the former range. In other areas of warning, you see this is really pretty benign. VIX futures still up above an 18. The week out expected move is still somewhat elevated, but there's really very little here to be concerned about. Fear and greed index still in the neutral. Really, the only thing that's mostly left over is this elevated VIX. Indeed, while much of the price volatility has been elevated of late, much of it's been positive. So really the primary thing that is still present in terms of warnings is this elevated VIX volatility. In terms of option income strategies, we're still holding as outside the acceptable window to initiate new positions for novice traders, though more experienced traders are certainly relishing much of this higher volatility that affords higher premiums, though they're having to work with the potential for higher delta and vega moves, and that certainly has been true. There's definitely been some need for adjustments as this market has run very, very bullish and big moves, and that is not typical of lower volatility readings. So this association of high VIX, high movement has absolutely been true. We saw with the S&P that 6 of the last 10 days have had a standard deviation move in the S&P. So you got to take that into mind if you're going to dabble with the option income strategies. We're still putting on positions, but we've had reduced position size to be able to account for the expectation that we're going to have more than usual adjustments. Though we're starting to perhaps ramp up on some of that position size as we've now moved into better and better situations. Cover call strategies, put selling, are absolutely acceptable if you're needing to put on additional delta exposure. These are great strategies that can be couched somewhat defensive. So we continue to be somewhat defensive, and we'll continue to let up on this defensiveness as the situation improves. So foot on the pedal more to accelerate more exposure in the portfolio, and yet at the same time we're also very aware of what's going on around us and not just simply barreling down the road with our eyes closed. That would not be appropriate. So get that additional exposure, but be very, very selective in what you're going into. At the same time, perhaps construct with some defensive aspects to the strategy, and kind of take care of both at the same time. In terms of sector market posture, and you see what we've been talking about, look at this: telecom, consumer staples, utilities, the ones that are holding up the very best and were there first were the defensive ones. So while we've certainly improved across the board with only financials holding things down, and again we look at financials as that's a warning sign. The fact that financials are not super healthy is a sign that this is not a super healthy bull market. You cannot have long-term persistence of bullishness without the participation of the financials, and they're being dragged along with the others. So very, very defensive nature is where the institutions are going, and you should note that and pay attention. Though you see yesterday, financials did have the biggest day, so they certainly made up some ground yesterday. The 1 day and the 5 day are both positive at this point, but you notice the 5 day, lags significantly behind all the other sectors with the exception of energy, which of course has been dealing with its own problems. And I think that's probably enough on that. Let's go ahead and wrap this thing up for today. We are right at 20 minutes, so I'm just going to slide through these. If you see something of interest, get to the hyperlink and get those details. Certainly you can sign up for the emails. That's very easily done. And the emails will allow you to be able to get warnings when hedge risk levels change, or I post a blog article. And I did post a blog article this week, very interesting article. If you go to falconglobaltraders.com/blog, you'll see that article there about bear funds. So you might want to pick that up. Disclaimers as always, hit the pause button if you need more time to review the disclaimers, and you see the hyperlink at the bottom to take you to the full set of disclosures. We'll see you back here Monday morning for the Falcon Global Market Preview. Good trading, everybody.